This is the charitable giving module for our 2025 One Big Beautiful Bill Act review. Some changes, some subtle but rather substantial changes this year for charitable giving. Number one, used to be previously that for non-itemized people who do not itemize deductions, unless you were donating appreciated stock or there was some other tangential benefit to making the donation, there was no deductibility for making a donation to charity. Beginning in 2026, not 2025, for the people who don't itemize, you can deduct up to $2,000 of what you give to charity. So I tell current clients, it's almost always the wrong decision to write a check to charity. It's better to donate appreciated stock because at least you're avoiding the capital gain. So if you had the same $2,000 and you have appreciated stock in an index fund or whatever, donate the shares to the index fund, to a church or whatever the charity is, and then use the cash to buy the stock back. You can do that with this this amount, but again, with the $2,000 limit, there's obviously some lower bounds on the benefit there. However, it is good to know that you can donate $2,000 and then have a tax benefit for it even if you don't itemize deductions. Okay, so that happens in 2026. If you're single, then it's just $1,000. Okay, so some of the bigger changes. Okay, so starting in 2026, not 2025. Okay, the charitable deductibility is going to be limited to 35%. So if you're in the 37%, the highest tax bracket, and you're donating to charity, your donation's only going to be of 35%, not at 37%. Okay. Also, starting in 2026, there's going to be a 0.5% of AGI, call it deductible or floor for your charitable deduction. So how's that going to look? And let's do a 2025 versus 2026 example for the same charitable contribution. Okay, so we're donating $50,000 to charity. AGI is 750, solidly in the 37% bracket. So in 2025, you'll get a full $50,000 deduction on your income. So basically, $50,000 out of the 37% bracket portion of your income is going to be reduced for an $18,500 tax reduction. Okay, that's for 2025, this year. Starting next year in 2026, same $50,000, same AGI of $750,000, taxpayers still in the 37% bracket. The charitable deduction is going to be reduced by 0.5% of AGI. So 0.5% of $750,000 is $3,750. So your $50,000 is going to be reduced by that much. And also, rather than being reduced in the 37% bracket, it's going to be reduced in the 35% bracket for the deduction. So the previous year, what was $18,500 is now going to be reduced to $16,188. Okay, so again, not tremendous differences, but subtle enough that if you have a choice between making donations in 2025 versus 2026, and you're in the 37% bracket, perhaps you would want to consider making donations this year as opposed to next year if you're doing some sort of strategy where you're bunching or donating appreciated stock or whatever it is. There are tangible benefits to doing it this year as opposed to next year. Okay, so for 2025, so again, building on the previous slide, if you're bunching and doing a donor advised fund thing where you're doing every 3 years, you're putting money into your donor advised fund, regardless of your bracket, because of that floor, 2025 is a good year to plus up your donor advised fund if you're a regular contributor to that. Again, appreciated stocks is always a good thing to donate because you're avoiding the capital gains tax. Now, in 2025, if you're only going to donate only $2,000 or so to charity and you do not itemize, then you may want to wait until next year, January 1st, to donate because then you'll get the $2,000 deduction in 2026. Okay, so those are strategies for this year. Now, I'll say again, I've said this many times, written a lot of articles about this. Qualified charitable distributions are one of the best parts of the tax code for those who want to avoid taxes on deferred income. The way qualified charitable distributions work is you contribute money to your 401k on a tax deferred basis. You get a current tax year deduction. Well, that is all well and good while you're younger. And then as you age and you get to be, used to be 70 and a half, it was increased to 73, now I believe it's 75, is when you're required to take money out of your IRA and realize the income. Well, starting at 70 and a half, what you can do is you can take money directly from your traditional IRA and you can have it donated directly to the charity. This, there's no RMD requirement yet at 70 and a half, but the income doesn't show up on your tax return. It's reportable, but it's not taxable. You just put the amount of distribution, 10,000, you write QCD on the dotted line, and then the taxable amount is 0. So this is not subject to the 0.5% AGI floor or the 37% bracket reduction that to 35 that we mentioned before. So if you are a super high income earning person and you intend to give money to charity all throughout the remainder of your life, current year tax deferrals make a lot of sense, because then in the future years you can make qualified charitable distributions, whereas you would have donated cash or appreciated stock previously. So nothing in the OBBA has changed for qualified charitable distributions. These are a wonderful, wonderful tool for folks who are charitably inclined in retirement. All right, so that wraps up the items we had for the charitable part of the OBBA. If you'd like to discuss how these principles may apply to your unique situation, please contact us and we'll set up a complimentary call to talk about how you can polish up and tighten up your charitable giving for both this year and the coming years. Thanks for the time. We hope to hear from you soon.